Hey y'all, it's your tax BFF, your tax strategist and your business coach. Today, I want to introduce this video to you. Is your business audit proof? So for the few of you that are here now, just in case you're new to me, I am Jenny Hendricks, full service accounting firm owner. I am the lead accountant and I focus on small businesses, developing them, growing them, teaching them strategies to avoid tax liability, decrease tax liability. Those are some of my specialties. I work with a lot of service-based businesses. So this year has been a very different, lots of changes. Actually, the last 3 years. Since the pandemic, tax time has been like, what they gonna do now? Are they gonna drop a stimulus? Are they gonna increase child tax credit? Are they going to eliminate something? So actually, we can go back to 2018 for the Tax Cuts and Jobs Act. That's when it really got ugly. So we got some stuff I want to talk about. Today, we're going to be talking about audits. The IRS, they trying to get your money. They're trying to get more money than they already are getting, and just how to prevent them and be ready. So we'll dive into it. I posted some stuff about Todd Chrisley. A lot of people were interested, so we're going to talk about that case as well. But I really just want you guys to be ready in the event that you are audited. Prepare now. Right now, it's the last month of the year. December 1st is tomorrow. We have to be ready to get prepared for tax season. If we're talking about deductions or how to get prepared for something during tax season, it's already too late. So that's why I wanted to make sure I kick this series off before the new year, kind of getting you prepared to get your documents in order and really take advantage of what's going on in small businesses. So this is going to be a 3-part series. It's called Audit-Proof, like bulletproof, you know. So I want to talk about, number one, why the IRS is coming after your business. Couple things, and I've mentioned this before, but 80% of the new IRS agents that they just hired, 80%, they are going after small businesses. They are not customer service. They are not going to be answering the phones any more than they do now. They will be in the streets, field auditors, field IRS agents. This is something huge to know. It's something that you need to really be prepared for. 4 to 9% will come from businesses making $500,000 or more. So 4 to 9% of audits, did you hear me? Less than 10 will be for businesses that make over $500,000. I say that to say, this isn't something, a lot of people think, oh, the big businesses, they're going to come after the big businesses. They're not thinking about my small business. Actually, the majority of audits come from people who are making $25,000 or less, and 700,000 of the 1.2 million audits from last year came from businesses that were making $75,000 or less. Okay, internalize that. Let's let that sink in. Number one, your small business that you like, I'm barely able to pay the tax bill I got so far. How dare they come after me? They coming after you. And a couple reasons. One, you won't fight back. Big businesses, they're going to have a tax attorney on it. They're going to have their accountant working around the clock to provide the paperwork. They're going to have an explanation for every single deduction with the receipt and a summary. They are going to get it done. Small businesses, some of you won't even reply to their mail. So they're coming after you. That's quick. That's easy money for them. They send some paperwork, you don't respond, they have a bill on your head that is accruing interest daily. So small businesses, let's protect ourselves. Just before we even get into this audit talk, there are 3 types of audits. One is the paper mail audit. This is usually a document request. They typically pick out some of your larger deductions. Maybe it's supplies, maybe it's travel, maybe it's your car and truck expenses. And they say, submit the documentation to support your deduction. Receipts, pictures, emails, your business bank account, the biggest one. If it is coming from your personal account, just know that every single deduction on your return is subject to them saying, nah. And every deduction that you add to your business reduces your tax liability. So for instance, any of you business owners who got a refund last year, if you got a refund and they see that you submit your personal checking account as proof of these expenses, they could say none of those expenses are IRS approved. And they can make you pay taxes on your gross income and wipe all of your deductions away. Let me just tell you how that's the last thing you want to happen, okay? The second one is an office audit. This one is a little scary. Ooh, I don't know. It made me feel uncomfortable, and I went in there really prepared. But you're sitting there, 2, 3 agents. They not kikiing with you. They don't have no compassion. They are there to get the job done. They have already made up in their mind how much money they're getting from you. Now they want you to explain to them why you shouldn't be giving them that money. A lot of people, you don't understand tax code. You don't really know what you're saying. All of that good stuff. It is something that will hurt you. They are waiting on you to just say one thing that sounds silly, to say one thing that doesn't specifically go to your business or your industry. They're waiting on you to just trigger them to be like, that's 10,000. That's another 1,000 that they owe us. So be sure that in the event that you have an office audit, either you're taking representation with you or you are at least fully prepared to write off every expense with a summary of how it made you make more money. So, and let me say that one more time, a little more clear, but every deduction that you take on your return, you should be thinking, did I have to make this purchase in order to grow my business, to make more money? How did this supply help my business? How did hiring this contractor help my business? How did this travel help my business? And you need to be showing the IRS that you are trying to make more money. For instance, I talk a lot about content creators and influencers and even business owners. We do a lot of stuff on live. Honey, I needed this red lip to do this video in order to try to get potential clients. I need to make that very clear when I write off anything as is surrounding this business or anything that's surrounding this live in particular. Keep that in mind. Be ready to defend yourself. And then the worst one. The worst one is a field audit. When they say, I'm going to come to your place of business and check it out. I want to see how you roll it. I want you to hand me the paperwork and let me see how you storing it. These audits typically cost them a lot more money in personnel just to make them happen. Just know they are looking for a large ticket. They're ready for their money. So audits are not intended to be so scary that, you get audited, you think, my business just has to file bankruptcy and I have to quit. No, but do know that audits are a large portion of the IRS's revenue that's coming in. They are coming at you with the intent on getting some money, okay? Don't ever get that twisted. They want you to show them that you are trying to be a top-notch record keeper, that you are on top of your stuff, that you are an industry standard. They want you to have your stuff so in order and your paperwork so in line that they have to look through tax code themselves to see if it fits. Okay, that's the type of record keeping you should be trying to practice. Every deduction or everything on your business bank account, every transaction should have an accompanying story. Okay, you write off your Starbucks run. Okay, yeah, meals and entertainment. But why? Are you saying that Starbucks was necessary to gain more clients? Did you have Starbucks with a client? What goes into that? You can't just show I bought a caramel macchiato on a Tuesday, and here go the receipt. And the IRS will say, oh yeah, Tuesdays I need caramel macchiato too. No, you have to say, I met with Jenny, my accountant, to talk about further deductions. It's as simple as that, but it's as tedious as that. Field audits are the worst. They're coming for that large ticket. Now, any of these audits, I never want you to give up. I never want you to say, you know what, I don't have time to put this together, or I know I ain't got no receipts, I ain't sending them nothing. You want to put your best foot forward, because what you are doing is now making a track record with the IRS. You're letting them know that even if they have some IRS tax code, rigmarole, that you came prepared, and you now, if anything, are learning what you need to do better. Okay, you don't want the IRS to say, oh, this person, we gonna catch them every year. We're gonna audit them every year. Or we'll never give them a refund again because I don't even know what they got going on. Okay, so you want to make sure any type of audit, you are working to get everything you need from it. Cool, so now, how to fight. Okay, listen. Would you go into a boxing ring and you ain't trained, you ain't ate right, your stamina, you walk up the stairs, you breathe hard, you ain't never fought a day in your life? So this IRS audit is a fight, okay? Get prepared. One, hire a professional. What's up with y'all trying to cut corners on stuff you just don't know? Okay, get familiar with IRM. IRM is the IRS's their internal employee handbook. Pretty much has everything that they teach all of their employees. It even shows you the acceptable answers to a penalty or the acceptable reasons as to why you didn't file something. And one thing, and this, if you don't take nothing else from me today, the IRS does not accept, I didn't know. Oh, my tax person ain't tell me that. Or, well, that's good to know. I was just so ignorant. Okay. One of my clients is an attorney, and they have a client who closed their business years ago, had an S corp, did not close it properly with the IRS. So the IRS has put penalties on every single year that they did not file their return. Okay, the penalty is $210 per month after that due date. Now, can she do a request for abatement? Yeah, for 1 year. Now she has to prove without a doubt that one of the acceptable answers that the IRS will take from you matches up, and she can get the rest of those penalties waived. However, if she say, well, I thought I did it, or I haven't been doing anything with the business, so I just assumed. She gonna owe that $210 per month for each of those tax years. A hefty penalty. So get that out of your mind. If you're like, I'm going into business and I'm just trying some stuff, or, maybe you filed your own S Corp election. You filled out your own 2553 form and you think you're on top of it. Just know, if you're doing this alone, you can't tell the IRS in the event of an audit that I just didn't know. That is a surefire way to get your penalty with the interest included, okay? Then, requesting for a penalty abatement. I just mentioned it, kind of threw it out there, but this is something that is real. They can give you a one-time penalty waive just like that, okay? They understand things happen, life happens, sometimes you miss deadlines, all of that, but it's only one time. Use it wisely, okay? Deductions that the IRS will fight you on every time. This is why this whole series even came about. One is travel. travel. We see so many Instagram videos, or, people saying, I took this trip to Bali on a company dime, or I, took my girlfriends on a lavish trip and caught in an advisory board meeting and all of that good stuff, right? All of these things are accurate, but you want to do them properly, okay? I really want to dive into travel so deep that is going to be my next series. Next week on Wednesday, we're going to be talking about travel and business vehicles. But business vehicles is another one. It's just like a home office. These are things that people want to write off in full. You want to write off your lights, your gas. You want to write off, every single oil change. But is it really 100% used for business? And if it is not, are you properly managing the number of miles driven for business versus personal? Are you properly taking the square footage of that home office in comparison to the entire house? Are you taking that percentage and then deducting things, or are you just writing it all off? Okay. Or are you using a standard deduction, like a mileage instead of the actual business lease or the actual, business repairs and maintenance? What are you doing? Take both into consideration at all times. Always look at, is the home office deduction better as the standard deduction, which is $5 per square foot, or is it better as a prorated percentage of the entire home? Same with the business vehicle. Whichever one comes out to be the most is the one you want to use, but you also want to make sure that you're properly documenting everything. For instance, if your kitchen / dining / kids do their homework / your office is the deduction that you're taking, just know you got an issue. Okay, just don't get it twisted. Have a designated office. Have a designated space where you store your products. Have a designated area that don't got no kids' toys or, pantry items inside of it, unless you're a cook of some sort. But have a designated space. This is something so easy for the IRS to look up. You can look up the blueprint of anybody's house, for real. They can say, hey, show me a picture of your office. And you're like, well, it's actually my bedroom. Okay, well, how are you taking a $1,500 deduction for it? Make it make sense. The IRS audit is, they already have the numbers of everybody else in your industry. They already know what tax professionals are doing. They already know how marketing professionals operate. They know what people in the transportation industry typically write off. And something about yours raise the flag, okay? Something may be a little too high. Maybe some just need a little bit of explanation. And that mail-in document request is just saying that. It's saying, hey, you have a consulting business, but you spent $15,000 in supplies. What were those supplies? Run me those receipts. You need to make sure that if your supplies were a whole bunch of Target runs, that you got the receipt showing that you were buying things for the office on those Target visits. You got the receipt showing that you were purchasing things to run that business from Target. And then you want to make sure that you have a summary and explanation as to why you need those things in order to grow and run your business. Simple as that. I tell the story with the numbers as your accountant. They want to further get your explanation as a leader in the industry on an audit. Okay? And then employees versus contractor. This is one that is, if you can just type it in to the search bar, you're going to find a whole bunch of videos on it. And I'm going to break it down more in detail in 2 weeks on our very final series. But real quick, I want you to know that an employee is anybody with set hours, anybody with a set salary, anybody who, if they don't answer that phone for you, is in trouble. Okay. A contractor is a vendor, someone who, works on a per project basis, someone who picks up stuff on their wherewithal and when they want to. It's someone that has their own business, probably. Okay, they're independent contractors. They're not anyone that is on a set schedule or a set time frame or at a set salary. So if you think you have a contractor, but you're paying them every single week or every single month or bi-weekly, for instance, the same amount, just know the IRS is going to need you to fully prove that that is not an employee. And the reason why they need you to fully prove it is because if they are in fact an employee, you owe them some employment taxes on that person. 15.3% to be exact. So just know, if in the event that you have a document request and they are requesting information about your contractors, that's what they want to see. They want to see if you are paying them equal amounts on a regular basis. They want to see what their job title is and what the description of their task is. They want to make sure that you can prove without a doubt that this is actually a contractor 1099 and not an employee that you need to run them some money on. All right. So top ways to get audited. The number one, don't claim all of your income. The IRS already has a transcript of all of your W-2s, all of your 1099s. Now they're about to have your Cash App, your Square, your Venmos too. They are already saying this person should be submitting me a minimum of this amount. If you submit this amount, audit. Couple things to do. Don't rely on 1099s. Every single business owner is not sending out 1099s. So if you worked with somebody one time, or my coaches or who are high ticket, and you getting $5,000 for one person at one time, yeah, you're not necessarily going to get a 1099 from them. However, you must claim that income. So making sure that you are organized and keeping track of everything that's coming in is essential. Making sure that in the event of an audit, you can show the IRS, I got this much from Square, this much from Venmo, this much from Zelle, right? And I got it all into this business bank account is important. And then also making sure that any deposits on your bank account that are not income, you have noted on your spreadsheet or your report of income as well. So if it's any returns, you bought something from Amazon, you sent it back, they deposited the money back into your account, the IRS will look at that as like a deposit, even though it's a return. But you have to show it on your documentation that was a return. Or if you go out to dinner with your friends and everybody Cash Apps you the money, but they do it to your business account, you need to document that this was a repayment of this bill that was personal. Those funds that are coming into that account must be accounted for in full with a summary or some type of report. Regardless if you're using an accounting software or if you just have an Excel sheet, every single thing in that business bank account needs to be accounted for and it needs to make sense. So, cash businesses, the IRS is on your head. Okay, just know that. So, my beauticians, I don't know if I just got the cream of the crop, which I probably do. They want their money through the app. They want their money before you even show up, paid it for. They invoice you, all of that. But typically your hair, your nails, that industry, the beauty industry is one of the barbers, the higher cash-based industry. They want to see some deposits being made on a regular basis. Okay, and they want you to account for those deposits. So even if you're in a fast-paced industry and you just, we've been to a nail salon and my Asian counterparts, they be in there, they write their stuff down, they put it in their little drawer. Let me just tell you how they are keeping records that we need to be keeping. Like if you are in a fast-paced cash business, you need to at least be writing something down on a ledger, writing something down in a notebook, something that we can show the IRS that you are keeping track of what's coming in. So all of that was a mouthful. I hope you learned something. But now I want to talk about the juiciness of Todd Chrisley and his wife. Oh my goodness. So if you don't know about the Chrisleys, they are a TV personality, quite entertaining actually, but they just got sentenced to prison. More than a decade apiece. And their accountant got 3 years on top of that. So I wanted to look a little bit more into this and see exactly what the case kind of unveiled and see how these people on this large magnitude, these are, multimillionaires that were evading taxes, what they did wrong that can relate to us. Okay? Couple things. They created a loan out company. A loan out company is a corporation with just one sole proprietor, and it's typically created in order to evade the IRS. You're putting money into it, and then you spending it out, and you're saying it's the corporation operating over there. I don't do anything with it. I'm just the sole proprietor. They created this company under his wife's name. Through that company, they were depositing their W-2 income from the TV stations, right? All of this big money, they're putting it into the corporation, and then they are buying, their lavish cars, their houses, their jewelry, everything out of that company. Well, a couple things they did wrong. One, they didn't file taxes from 2013 to 2016 personally. No personal taxes came, even though they're getting millions of dollars in W-2s from syndication and doing their show. Okay, no tax return. So red flag, IRS is like, you ain't filed your taxes? What's up? But then they did file a couple of their corporate returns. So their 1120S's were submitted and said that the business didn't make any money and the business did not make any distributions to owners. But the business had millions of dollars going into it and millions of dollars going out. What? Okay, so how many of us know maybe a plant worker who making some good old money and don't want to pay no taxes? So they create a business and, claim a loss on it so that they can deduct their tax liability and maybe even potentially get a refund. Essentially, they kind of making a form of this loan out company. They're saying that I'm making the money and I'm putting it in this company so that it can buy all of these expenses for the company, but I'm just not making any money. Red flag to the IRS. So if you're using a business, especially one that you don't plan on making money with, or you don't even plan on operating, you're just using the expenses to lower your tax liability, it's a red flag, and have fun explaining that to the IRS. Okay. And then here's another thing that they did. They falsified bank statements. So for instance, you got to file some tax returns in order to get loans, right? To get big loans, mortgages and things of that nature, you have to have some tax returns showing your income. Well, they didn't file no tax returns. So they had these bank statements from their personal accounts that show all of this big money. Money that the loan officers was like, ooh, Lord, they got this type of money coming in. We don't even need to see no tax returns, okay? They were falsified. Couple things. One, business owners, if you are deducting everything, you are not only reducing your tax liability, but you are also reducing your gross income. Meaning that when you go to purchase a home and they say, let me see your tax returns, and they see an adjusted gross income of $25,000, they say you can't afford this home. And you're like, no, I make money. No, my business make $100,000. Well, it looks like you deducted $75,000. So your business is not really viable. So that's one thing you can get in trouble with as far as needing loans or wanting to do that type of thing. Another thing, if you are an S corp and you try to pay yourself the smallest amount of a W-2, so you're paying yourself, $25,000, $30,000 on a W-2, that is going to go onto your return. On your personal return, it would then show that you're at a Schedule K-1 with the amount of money from your business. I don't know if I got any loan officers on here, but try explaining to them that you can use all of that money that's in that business. Is hard, okay? So they're going off of your W-2 income. And again, it looks like you can't do anything. So the Chrisleys not only didn't have tax returns, but they falsified information to put themselves in a better light. Some of you want to do an amendment on your tax return to show more money so that you can get approved for this mortgage. Well, two things. If you don't submit that amendment, you don't have a transcript. And if you do submit that amendment, you will owe a lot of money in taxes. Let's be proactive in this thing. Let's do our estimated taxes. Let's pay our tax money when the money is coming in, not at the end of the year when you already spent it all and you're like, oh, where's my money supposed to come from? Be proactive. And then don't try to out shady the IRS. I don't understand. Like, there are tens of thousands of dollars, of pages, tens of thousands of pages of tax law that pretty much just show you how to reduce your tax liability. So there are legal ways to properly do this, but you do have to think of things in totality. Are you deducting everything so that you reduce your tax liability, but now you can't buy something? Or are you not deducting anything and keeping your tax liability way too high just so you can afford this mortgage? Properly plan this thing out, guys. But back to audit. They probably could have gotten away with this a little better had they filed on-time returns. Like, it might have been that simple. Had their accountant said, we're not going to miss a year of tax returns. We go file this 1120S. We go give you both Schedule K1s showing that the business is failing, and we're going to put it on there with your W-2 income, and it is what it is. They were already getting all type of money and ain't paying no money. File those tax returns. So don't falsify information. File your taxes on time, avoid unnecessary penalties, and do not create a business entity, especially a corporation, in the event that you just are trying to reduce your tax liability. Don't do it. So I hope you guys really enjoyed this. When I first told my social media manager and content creator that I wanted to do a series called Audit-Proof, he was like, are you married to this idea? And I almost fired him. I'm like, boy, talk to me like that. But I was like, well, no, but I know it's so necessary. And one of my passions in business is being able to help business owners, especially women of color. One of the things we lack the most is resources. So if I can't give you this knowledge and hopefully share something with you that can save you so much money, millions over the course of your business life, then what am I here for? Just to entertain you guys? So I'm doing it. It's a 3-part series every Wednesday. We might be changing the time. I don't know. I'm going to do a little poll to see if y'all maybe want to join me for lunch, because getting the kids down and dinner ready and all of that and still trying to look cute by 8 o'clock was a lot on a Wednesday. But I do want to keep it going. Next Wednesday and the Wednesday after, we'll be jumping on. We'll be talking about travel. We'll be talking about business vehicles. We'll be diving into employees versus contractors and really getting you prepared to have your documentation in order to not go to jail because the IRS is after your pockets. So I think I see a couple questions. You can always DM me. I'm always open to talk. The link is in my bio. I know y'all be hating to hear that, but it is. If you want to book a consultation, it's just taxteamservices.com/book appointment. I'm available. And as we are leading up to the end of the year, I suggest you getting on my calendar prior to tax season if you are trying to game plan. And you only got a couple weeks to do that, because I'm taking the last 2 weeks of the year to just get my life together for tax season. So I love you all. Like I said, I am here to be a resource for you, and I appreciate you joining me live. You could be anywhere in the world, but you right here with me. Yeah, little JC, y'all. But for sure, DM me. Let's talk. Let's game plan. Let's not give the IRS all of our money, but let's do it properly.